Hello everybody, in this video we'll be beginning with the chapter number 11, volume, the technician's description device of CMT level 1. Before watching this video, make sure to check the previous chapters. In case you haven't, then I've linked it in the description box below. So in the previous chapter we saw the overview or introduction to volume analysis, and we saw how volume analysis is going to help us in our trading journey, right? So now we'll see that in a little bit more, just a second. We'll see it in a more advanced form here. So let us start. Again, I'll be showing you the PDF of the Wiley's textbook itself, since this is also a very tiny chapter. So these are the learning objectives. First, we will be learning the implications of volume changes for price trends, and then we'll be able to identify trends in price and volume in a chart. How are we going to identify the trends in a chart? We'll be able to describe how volume is displayed in a volume at price chart, define VWAP. VWAP is an indicator which is there on your trading portal. I will show that to you. And then we'll be seeing equivolume charts. That's another form of charts where the price and volume both are represented on the same chart. We will now also see how does an open interest rise and fall, how do you get to know, and state the implications of open interest changes for price trends. So these are the things which we are going to see over here. So first, let's talk about decoding volume. Although the financial broadcasts would have us think otherwise, the market does not simply wake up and inform us of its mood each day. The market speaks to us through its behavior. So behavior, two things which we can judge the market on the basis of. One is the price, because price is always supreme, and the second thing is the volume. When you combine volume and when you combine price together, if you analyze these two things, you will be very good with your trading. In a real way, though, the mood of the market is encoded. Codes are messages containing hidden meanings. Now let's look at this chart over here. Look at this. The price is rising, the price is increasing. I'm over here. The price is rising, the volume is also rising. What does that mean? That the buyers are in high volume and the price is also rising. That means the demand is increasing. That means since the volume is also in the favor of the rising price, so that means the implication is bullish market. Very simple. The price is rising but the volume is falling. What is this? The price is increasing, there is an uptrend, but the buyers are not that interested. The volume is low. That means there is no demand in the market. The demand is decreasing. That means it is bearish. That means that the price is going up right now, but since it's not supported by the volume, it might just come down soon. Next, we have a falling price, volume is rising. So a downtrend is going on, the price is falling, and when the downtrend is going on, when the price is falling, the volume is high, which means the sellers are very much interested in taking the price down. That means there is a lot of supply. Increasing supply, that means it is bearish. The last one, price is falling, volume is also falling. So there is a downtrend in the market, but it is not supported by the volume since it does not have high volume. That is giving you an implication that the downtrend might come to an end because the sellers are not in the favor. There is no enough supply. So that is decreasing supply. So the view is bullish because the market might now just change and go upwards. Extraordinarily high volume is the clearest technical indication that the market is poised to move. When volume is high, the market expresses firm conviction, like bold capital letters in print. So we already saw in the previous chapters about how you need good volumes, right? Let me show you a chart. I keep showing you the same chart over and over again of Chola Finance. Let me go to something else this time. Let's go on crude oil futures. It has my analysis, so let me go somewhere else. Okay, let's go on JSW. This is Jindal Steel. Let me remove all my analysis, my previous analysis. Okay, so now if I put volume bar over here, volume, look at this. And if I go to the daily chart, look at this. Look at the volumes over here. So here there is an uptrend, here there is a downtrend, there is a downtrend. Okay, look at this, there is a downtrend over here, but the volumes are not so strong. Look at the volumes over here, the volumes are bland as compared to these volumes and as compared to this big volumes over here. If you compare with that, in this big fall, in this downtrend, the volumes are not high. This gave me an indication that the downtrend is not that strong and the stock might just go up now. And what happened after that? The stock went up. So that's how you can see that volume is always essential. Displaying volume. There are many ways technical analysts display volume. In discovering your own preference, keep in mind that volume gives meaning to price. So there are various ways using which you can see volume. There are various indicators which are also there. Volume directly under the price. So volume typically is displayed directly below the price data in time-based charts. This method can be applied to all time frames. So if you look at this chart over here, this is my price chart, this is a bar chart over here. This is my price chart and below it are my volume histograms. Like the ones which I just showed you in your trading view. The price chart is over here above and my volume chart is right below the price. This is the first way of displaying your chart. The second thing is volume at price. What is volume at price? Volume at price is also known as your volume profile. So what does that mean? Let's talk about it. Another way to depict volume data is to plot volume horizontally on a vertical axis. While price and volume are normally plotted in a time-based chart, volume at price, known as volume profile, plots volume horizontally, either from left to right as a histogram. Let me show you figure 11.2. Okay, so if you look at this figure, look at this figure where the volume is plotted horizontally. Volume at price. Can you see that? This is your price and your volume is also depicted on the same chart. So this is basically known as volume at price, which means that price and volume both are depicted on the same graph. Earlier what we saw that was volume was depicted below, right? So what is volume profile? Volume profile is always volume at price. Now we come to VWAP. VWAP is a very essential thing which is used by people. VWAP is also known as volume weighted average price. Before we go into the technicalities, let me show you the VWAP indicator. So go on your indicators and just type VWAP, then you get your VWAP over here. And let me change the color of the VWAP to black or white. I'll change it to black and let me make it really thick. Okay, so now look at this. If you can see, there is a black line over here, right? There is a line over here. So that is my VWAP indicator. Right now I know it's sticking to the price, but if I go on a shorter time frame, like a 5-minute time frame, look at the black line. The black line is my VWAP. Here you can see it more clearly, right? So that is my VWAP indicator. Let's see what is the meaning of the VWAP indicator. So the volume weighted average price is the average price, okay, typically for one trading day, with each of the price points weighted by volume traded at that price. So it is the average price. So average price divided by the volume, that is going to give you a VWAP line. It is typically plotted on the price chart just the way a moving average is plotted. So the same way how a moving average is plotted, the same way even the VWAP is also plotted. So how do you basically calculate a VWAP? You calculate a VWAP by dividing the price with the volume. Very easy, simple to understand. This intraday indicator, again, look at this. This is very essential. This is an intraday indicator. Why is it an intraday indicator? If you can recall, when we saw the trading view chart, we saw that when I'm using it on a daily chart, the VWAP is sticking to the price and I wasn't able to use it as much. But when I saw it on a 5-minute time frame, that was far from the price and it was giving me a proper outlook. So that is why they say that VWAP is an indicator which is used for an intraday basis. VWAP is equal to sum of tick price multiplied by tick volume divided by my trading volume. Please remember this formula. VWAP is sum of tick price multiplied by tick volume divided by your trading volume. Okay, so it is just the price. So what is price? Price is tick volume multiplied by tick price. So you are going to add that and divide it by the tick volume. So VWAP is used more as a statistic than a true indicator. It is the industry standard to determine the price at which a stock can be bought or sold throughout the trading session. So that is my VWAP. Now we'll come to the next form, which is my equivolume chart. So what is my equivolume chart? Equivolume chart. If the market wore a wristwatch, it would be divided into shares, not hours. That is a very famous quote which is given by Richard Arms. So Richard Arms basically epitomes those thoughts with equivolume charts. What are equivolume charts? Let's see the figure 11.4. You'll be able to understand. So if you look at this chart given over here, what can you see? You can see that when this is how a normal chart looks like, normal candles or normal bars look like. The moment there is a high volume, in that situations the bars are also high. So that is also showing you the price, and at the same time it is also showing where high activity took place or high volume took place, right? So that is what is my equivolume charts. Equivolume charts set the width of the price bars by comparing volume of the bar. So the width of the bar is big if it has high volume. That is how it is shown in your equivolume charts. So in your equivolume charts, you basically have the width of the bars. The width of the bars is huge. Wide bars show stronger volume, whereas thin bars show weaker volume. Very basic. Arms call a tall and wide bar a power box. So what is a power box? A power box is a bar which is big, which has a wider range. So that also, so when you have a white candle, it shows the price movement along with strong volumes. Power boxes are important. So power boxes is just a white candle. Okay. So the existence of power boxes during a breakout or a breakdown indicates a high probability of success. So why have they said that? So we've already discussed this multiple times, that if you want to confirm a breakout or if you want to confirm a breakdown and you want a proper breakout or a breakdown, you need to confirm it with volumes. If your volume confirms a breakout or a breakdown, then you can say that the breakout is true. If there is a breakdown wherein the volume is not high, then that can probably be a fake breakout. So that is how you are going to use your equivolume. Equivolume is a usual charting application emphasizing price and volume relationship. Let me see if there is equivolume charts. I don't know if it's free or not. See. Regular. Okay, so it basically just shows you those bars where the volumes are really high. So it's not really free on TradingView. So you can use other softwares if you're really interested, but I've explained the concept to you. Okay, so now we come to the next topic, which is volume and open interest in the futures market. Volume is the number of contracts traded. We have discussed that. And what was open interest? We have discussed that also. Open interest is the current number of outstanding futures contracts, the contracts which haven't been closed yet. The contracts which are open yet, that will basically show you your open interest. Whereas volume is when your trades have been closed, right? Total open interest is the sum of the open interest in all the delivery months in that market. It takes a new buyer and a new seller to create a new contract or increase open interest. As contracts are closed, open interest declines. So if I'm closing my contract, my OI falls down. Very simple, basic. And when a former buyer sells to a former seller, a contract is closed and the open interest declines. When contracts are traded between one party exiting a position and one taking a new position, that trade generates volume but does not affect open interest. Let's read the last line again. When contracts are traded between one party exiting a position and one taking a new position, that trade generates volume, but that does not affect the open interest. Okay. Now let's look at the table 11.2 and let's try to understand it. So here we are basically given a buyer. So a buyer is taking a new buying position. A long position means a buying position, and the seller is taking a new short position. So the buyer is buying from someone and the seller is selling. So in that situation, a contract is open in the market. So this means that my open interest increases. Current short position, which means the buyer is basically having a short position right now and the seller is current long position. In that case, what happens to the open interest? It has something to do with volume. This is not a new position, right? This is just there. So in that case, the OI basically decreases, right? New long position, current long position. Read it again. New long position. The buyer is taking a new long position. The seller is basically in the current long position only. So in that case, what really happens is that nothing changes. Current short position, new short position, unchanged again. Okay. If you have any doubt, try to rewind the video and watch it again. However, I'll quickly discuss it again. New long position, new short position, OI increases. Current short position, current long position, OI decreases. New long position, current long position, unchanged. Current short position, new short position, unchanged. Okay, now let's interpret volume and open interest. The first case, volume is rising, open interest is rising. So if both of them are rising, price trend is being confirmed. Volume is rising but OI is falling. That means there is not much interest. Volume is falling but OI is rising, which means accumulation is taking place, but it is not strong. It is weak since the volume is weak. Volume is falling, open interest is falling. So in that case, the trend is being contradicted. Interpretation of price, volume and open interest. The price is rising, volume is rising, open interest is also rising. That means new buyers are coming into the market. The price is rising, the volume is falling, the open interest is falling. That means it is a short covering rally, right? Because the price is increasing, but there is no volume in it. Price is falling, volume is falling, open interest is falling. In that case, what happens is the price has come to its bottom. Now people are losing their interest in short selling. So that means the market is making a bottom over here. Price is falling, volume is rising, open interest is rising. That means shorting is coming in the market, new shorts are taking place in the market. Okay. So now we come to the next topic, which is seasonal volume tendencies. Give me a minute. Okay. Seasonal volume tendencies. You can pause it and read it by yourself. This is basically, they're just showing us that when the volume is high and when the volume is low. Sometimes according to the seasons the volume increases, in holidays the volumes are low, and so on. So that is it with my chapter number 11, which was volume, the technician's description device. So hope all this was clear. The VWAP formula is sum of tick price multiplied by tick volume divided by your trading volume, and equivolume charts, you know what equivolume charts are. In the next video I will be starting with the chapter number 12. Thank you.